The European Union just made a catastrophic mistake. In what they thought was a masterstroke of economic warfare, EU leaders seized $105 billion in Russian assets frozen since the Ukraine invasion began. They transferred the money to Ukraine as aid, compensation, and a symbol of Western resolve. It was supposed to cripple Russia, demonstrate Western unity, show that aggression has consequences. Instead, it triggered a Russian response so devastating that European governments are now quietly panicking. Russia didn't respond with military escalation. They didn't launch cyber attacks or cut off remaining energy supplies. They did something far more effective. They rewrote the rules of international finance in ways that will haunt Europe for decades. What I'm about to reveal isn't just about Russia and Ukraine. This is about the unraveling of the post-World War II financial order and Europe's role in its own economic destruction. Let me start with what the EU actually did. Since February 2022, when Russia invaded Ukraine, Western nations froze approximately $300 billion in Russian central bank reserves held in European and American financial institutions. This was unprecedented. Never before had the West frozen the sovereign assets of a major power on this scale. The legal justification was shaky. These weren't assets of individuals accused of crimes, but the reserves of a national central bank. For 2 years, these assets sat frozen. Russia demanded their return. The West refused, but actually seizing and transferring the assets required a legal framework that didn't quite exist. European lawyers warned that outright confiscation would violate international law, undermine the sanctity of sovereign reserves, and create dangerous precedents. Politicians ignored these warnings. In November 2025, the European Council voted to seize $105 billion of the frozen Russian assets and transfer them to a Ukraine reconstruction fund. The legal mechanism was creative. They declared the assets reparations for Russian aggression. The announcement was triumphant. EU leaders praised their own courage. Media celebrated the move as justice for Ukraine. Politicians competed to claim credit. Russia's initial response seemed muted. A few angry statements from the foreign ministry, promises of consequences, the usual rhetoric. Western analysts dismissed it as bluster. What could Russia actually do? They were already sanctioned, already isolated, already cut off from Western markets. This was the fatal miscalculation. Russia's retaliation came in 3 waves, each more devastating than the last. Wave 1, reciprocal asset seizure. Within 48 hours, Russia announced the nationalization of all European corporate assets on Russian territory. BP's stake in Rosneft, $14 billion, gone, nationalized. Shell's Russian operations, $3 billion, seized. Total Energy's projects, $4 billion, confiscated. Societe Generale's banking operations, taken over. German automotive plants, Volkswagen, BMW, Mercedes facilities worth billions, nationalized pharmaceutical operations, food processing facilities, retail chains, infrastructure projects, intellectual property. Everything European companies owned in Russia was suddenly Russian state property. The total value exceeded $120 billion, more than the EU had seized. European boardrooms erupted in chaos. Shareholders demanded answers. Stock prices plummeted. Insurance companies faced massive claims, but this was just the opening move. Wave 2, the energy retaliation. Russia announced that all remaining energy exports to Europe would now be priced exclusively in rubles or yuan, no euros accepted. This was different from previous energy threats. Russia wasn't cutting supply. That would hurt their own revenues. Instead, they were forcing a currency choice. European countries that wanted Russian gas or oil had to acquire rubles or yuan first. This meant going through Russian or Chinese financial intermediaries, paying fees, accepting exchange rate risk, losing transparency on pricing. But the real impact was psychological and systemic. By refusing euros, Russia was making a statement. Your currency is no longer acceptable to us. The euro, which Europeans assumed was a global reserve currency that anyone would accept, was being rejected by a major commodity exporter. This had cascading effects. Countries that needed Russian energy had to hold ruble reserves. This meant selling euros to buy rubles. Euro selling pressure increased. The ruble, which Western sanctions were supposed to destroy, strengthened. The currency that was supposed to be worthless became necessary for European energy security. China benefited enormously. Countries buying Russian energy in yuan had to acquire yuan first. This accelerated yuan internationalization at the expense of the euro. The European Central Bank watched helplessly as energy importers dumped euros for rubles and yuan, weakening the euro and importing inflation through currency depreciation. Wave 3. The financial architecture strike. This was the move that truly shocked European capitals. Russia announced the creation of the BRICS Plus Reserve Fund, a $150 billion pool capitalized by Russia, China, India, Saudi Arabia, UAE, and other nations that had grown wary of Western financial weaponization. The fund's purpose to provide liquidity and financial stability for countries that faced Western sanctions or asset freezes. Think of it as an alternative IMF for the sanctioned and the nervous. But the real innovation was the mechanism. The fund would accept sovereign assets for safekeeping, but these assets would be held in distributed custody across multiple non-Western jurisdictions. No single country could freeze them. No Western court could seize them. The assets were legally structured to be seizure-proof. China contributed $50 billion. Russia committed $30 billion. Saudi Arabia and UAE added $25 billion each. India, Iran, and others filled out the rest. This wasn't just about the money. This was about creating financial infrastructure that bypassed Western control entirely. Countries looking at what happened to Russian reserves in Europe had to ask themselves, are our reserves safe in London, Frankfurt, or New York? The answer increasingly was no. The capital flight began immediately. Saudi Arabia quietly began diversifying its reserves away from European assets, not selling everything, but reducing concentration. UAE moved portions of its sovereign wealth fund holdings from European bonds to Asian assets. China accelerated its de-dollarization efforts and reduced euro exposure. Even non-aligned countries like Indonesia, Malaysia, and Mexico began discussing reserve diversification strategies. The amounts involved were staggering. Sovereign wealth funds and central banks hold trillions in European assets. Even a 10% reduction represents hundreds of billions in selling pressure. European bond markets felt the impact. Yields rose as demand decreased. Borrowing costs for European governments increased precisely when they needed to borrow more for Ukraine aid and energy transition spending. The European Central Bank faced an impossible choice: intervene to support bond markets by buying government debt, reigniting inflation, or let yields rise and watch governments struggle with debt service costs. They chose a middle path that satisfied nobody, limited intervention that prevented crisis but didn't restore confidence. Let me show you the ripple effects across European economies. Germany was hit hardest. German manufacturers had invested more heavily in Russia than any other European nation. The automotive sector alone lost an estimated $30 billion in Russian assets. BMW's plant in Kaliningrad, gone. Volkswagen's operations seized. Mercedes facilities nationalized. These weren't just sunk costs. They represented future revenue streams, market access, competitive positioning. German companies that had spent decades building Russian operations saw that investment evaporate overnight. The political fallout in Germany was severe. Opposition parties attacked the government for supporting asset seizure without protecting German corporate interests. Business lobbies demanded compensation, but the German government had no good answers. They supported the EU decision for solidarity. Now German companies were paying the price. France faced similar problems. Total Energy's Russian losses triggered shareholder lawsuits. The French government's stake in companies with Russian exposure declined in value. Société Générale's Russian banking operations, built over 15 years, were gone. The bank took a $3 billion write-down. Italian energy companies with Russian partnerships faced nationalization. Spanish food processors lost facilities. Dutch agricultural firms saw Russian operations confiscated. Every major European economy had companies suffering massive losses from Russian retaliation. The energy situation became acutely painful. European countries, still dependent on Russian energy, and despite diversification efforts, several remained dependent, now had to navigate the ruble payment system. Hungary, which had maintained pragmatic relations with Russia, adapted quickly. They set up ruble accounts and continued energy imports. But this created political tensions within the EU. Countries that refused Russian energy on principle watched Hungary get cheaper energy by accepting ruble payments. Austria, Slovakia, and parts of Eastern Europe faced similar choices: accept ruble payments and get energy, or refuse and face higher costs from alternative suppliers. The EU's unity on Russia policy began fragmenting along energy dependency lines. Countries with Atlantic LNG access could afford to be hawkish. Landlocked nations dependent on pipeline gas had to be pragmatic. This is exactly what Russia wanted: division within Europe. The precedent effect was even more damaging than the immediate economic impact. Every country with reserves in European financial institutions had to reconsider their safety. If the EU would seize Russian assets, what stops them from seizing Chinese assets if tensions escalate over Taiwan? Or Saudi assets if there's another oil dispute? Or any nation's assets in a future conflict? The answer: nothing stops them. The precedent is set. This realization triggered what financial analysts call a confidence crisis in sovereign asset safety. Central banks exist to manage reserves prudently. Prudent management means minimizing risk. If European assets carry seizure risk, they're imprudent holdings. The logical response is diversification away from potential seizure jurisdictions. This doesn't happen overnight. Central banks move slowly. But the direction became clear: reduce European exposure, increase holdings in jurisdictions with stronger property rights protections or less geopolitical ambition. Ironically, this included increasing holdings in Switzerland, neutral, Singapore, pragmatic, and even China, which now looked safer than Europe for non-Western reserves. The European Union's aggressive use of financial warfare made European assets less attractive globally. Let me show you the long-term strategic damage. For decades, Europe benefited from being seen as a safe, neutral place to park money. Swiss banking secrecy, Luxembourg fund structures, London financial services. European financial centers competed with New York to attract global capital. The euro was promoted as an alternative reserve currency to the dollar. This positioning depended on trust. Trust that property rights would be respected. Trust that political disputes wouldn't trigger asset seizures. Trust that rule of law would prevail over geopolitical expediency. The Russian asset seizure shattered that trust. Now European financial centers are seen as potentially hostile to non-Western capital. The rule of law image is replaced by rules-based order, a phrase increasingly understood to mean we make rules that benefit us and change them when convenient. This has profound implications for the euro's reserve currency aspirations. Central banks hold reserve currencies for safety and liquidity. If European assets can be seized for political reasons, they are neither safe nor truly liquid. The euro's share of global reserves has been declining for years. The Russian asset seizure accelerated this trend. Countries don't trust the euro the way they once did, and trust, once lost, is extraordinarily difficult to restore. China emerged as the massive winner from Europe's mistake. Every dollar of reduced European asset holdings goes somewhere. Much of it went to Chinese assets or yuan-denominated instruments. China's de-dollarization and de-euroization campaign received an enormous boost from European actions. The BRICS Plus Reserve Fund became an instant success. Countries queued to participate. The fund's capitalization target of $150 billion was reached within weeks. China positioned itself as the protector of sovereign asset rights, the defender of financial stability against Western weaponization. This wasn't just propaganda. China was offering real alternatives: yuan payment systems, custody solutions outside Western control, financial infrastructure that couldn't be sanctioned. Europe's aggressive move accelerated China's financial architecture build-out by years, possibly decades. The irony is brutal. Europe seized Russian assets to punish Russian aggression. The main beneficiary was China, Europe's strategic rival. The legal implications are still unfolding. Russia filed cases in every international forum: the International Court of Justice, the Permanent Court of Arbitration, European Court of Human Rights. These cases will take years. Russia will probably lose most of them. But that's not the point. The point is to establish a record, to document European violations of international law, to create legal precedents that other countries can cite if they face similar treatment.